This isn't a silver rally that went too far and cooled off. This is a market that screams stress, and the people who keep the plumbing from bursting just slam the brake pedal into the floor. The conflict is simple and brutal. The chart wants to go vertical, but the market structure keeps trying to force it back into a box. And the hidden mechanism most people missed isn't some mystical headline. It's the way leverage, delivery timing, and spreads turn a normal breakout into a forced liquidation event. Stay with me, because by the end you'll have three concrete things: the levels that matter, the two scenarios for the next 1 to 2 weeks, and the single checklist that tells you whether $80 is dead or just delayed. Here it's the price context in one breath. Silver ripped to an all-time high around the mid-80s, roughly 83 O's. 6 at the peak, then it snapped down toward the low 70s, around $72, with the kind of speed that makes people swear the screen is broken. That's not a normal pullback. That's what happens when a crowded leverage trade hits a sudden increase in the cost of carrying risk. And if you think the violence means the thesis is over, pause, because the move itself is the message. This is exactly what stress looks like when price discovery is happening in a leveraged futures complex, while the real-world supply chain can't expand on command, and that's where the real pressure starts. Now about that emergency weekend meeting vibe in the title. In markets, the loudest meetings aren't always public. They're risk calls, clearing members, margin committees, risk desks at brokers calling clients who are overextended. When silver starts printing multi-dollar candles, and the volatility spikes into year-end thin liquidity. The system does what it always does. It raises the bar. Margin requirements go up. Collateral gets demanded. And suddenly, people who were right on direction become wrong on survival. Because if you're leveraged, direction isn't enough. You need time. And time is exactly what higher margin steals from you. This is the mechanics that most retail never fully internalizes, and it matters right now. A futures contract is not buying silver. It's a leveraged bet with daily settlement, a clearinghouse in the middle, and strict collateral rules that can change when volatility changes. When the exchange raises initial margin, think numbers like moving toward the mid-hour $20,000 range per contract for certain silver futures, anyone holding size on leverage is forced to post more money immediately or cut exposure. There's no debate. There's no "but my thesis." The system isn't judging your thesis. It's managing default risk. And when that margin hike lands into thin holiday liquidity, it's gasoline on the most dangerous kind of fire: forced selling. That's why the drop happened now. Not because the world suddenly stopped needing silver, not because solar panels stopped being built on a Tuesday. It happened because the calendar turned the market brittle. Year-end is a trap for leveraged trades. Liquidity thins, spreads widen, volatility rises, and risk managers get allergic to outliers. And silver is the outlier's outlier. It's gold's hyperactive cousin. The moment it goes parabolic, the same structure that helped it run starts pushing back. But that's not the part that matters. The part that matters is what happens underneath the spot price, where the real signal lives. If you only watch the spot chart, you're staring at the loudest, most emotional layer. The hidden detail is in the structure: the spreads, the term curve, the behavior of paper, price versus physical urgency, and the way inventory categories constrain what can actually be delivered. Because in silver, the question is never just, is there silver in the world? The question is there deliverable silver in the right place, at the right time, under the right rules, at the right price? That distinction is where squeezes are born, and where they get violently interrupted. Let's demystify the paper versus physical tension without turning this into a lecture. Think of COMEX silver as a delivery game. You have futures contracts that can go to delivery. You have warehouse stocks that are reported in categories, commonly discussed as eligible and registered. The details matter, so keep it simple. Eligible is metal that meets specs and is stored in approved warehouses, but it's not necessarily committed to be delivered. Registered is the portion that AS actually in a form ready to be used for delivery against futures. The market can look well supplied on total inventory while the deliverable slice is tight. And when the deliverable slice tightens, the front end of the curve starts acting weird. That weirdness is the alarm bell, because if near-term metal is scarce, the price for now can rise relative to later. That's when spreads start talking. And spreads don't care about vibes. So what does that look like in real life? You see front-month strength, you see backwardation or near backwardation behavior, where the nearby contract trades richer than the deferred, or the spread tightens aggressively. You see lease rates and financing signals get jumpy. You see the market paying up to secure immediate availability. And you see more attention on delivery notices, warehouse movements, and what's actually being demanded. I'm not asking you to memorize data dumps. I am telling you what the mechanism forces participants to do. It forces shorts and intermediaries to source metal or to pay up to roll risk forward. And that's where the math changes. Now add the second layer: options, reflexivity. This is where a clean breakout can turn into a treadmill. When silver approaches a psychologically magnetic strike like $80, call buying tends to cluster. Dealers who sold those calls are not predicting silver, they are managing delta. As price rises, the delta of calls rises. Dealers hedge by buying futures. That buying can push price higher, which increases delta further, which forces more buying. That's the gamma loop. It's mechanical. It's why some moves look like they have a motor. But it is also why the snapback can be so savage when the motor is suddenly cut off, because if volatility spikes and margin rises, the system forces de-risking. Dealers can reduce hedges. Funds cut positions. The same reflexivity flips direction. And that's the part retail experiences as they're manipulating it, when in reality the structure is simply doing what structure does under stress. It amplifies. This is also why the weekend meeting story feels real even when you didn't see a press release. Because when a market trades like that into year-end, everyone with exposure is having a meeting. Brokers are calling clients. Risk is being repriced. And the cleanest tell is not the rumor. It's the behavior. Margin changes, volatility spikes, spreads reacting, and price snapping toward where leverage can survive. And that's where we are. Let's build the proof stack, because one argument is never enough in a market like this. First proof point, the price action itself. A spike to roughly 83. 6, and a quick trip towards $72 is not the footprint of a sleepy fundamental grind. It's the footprint of a leveraged blow-off followed by forced deleveraging. If you've seen 2011 silver, you recognize the shape. Not because history repeats perfectly, but because leverage repeats perfectly. Same incentives, same reflexes, same risk management playbook. But the next detail is what flips the whole setup. Second proof point, margin and collateral dynamics. When initial margin rises, especially into a high volatility window, it changes the composition of who can hold the trade. The weak hands aren't retail, the weak hands are leveraged. Anyone running tight collateral has to cut, even if they're bullish. That forced selling is not bearish information, it's mechanical liquidation. The moment you understand that, the post-spike dump stops feeling like the story ended and starts feeling like the structure flushed the leverage. And flushes are often where the next trend leg is born. Not always, but often enough that you don't get to dismiss it. Third proof point, the calendar trigger. This is the worst possible time for a market to go parabolic. End of year means thin liquidity. Funds are marking books. Risk limits tighten. Some players don't want to carry outsized exposure into year-end statements. Option books roll. And then, right after that, you have a clean date on the calendar that matters for real supply chains, January 1st. There has been widely discussed talk of China rolling out a tighter export licensing regime for silver starting January 1st, 2026. More bureaucracy, more friction, more control over which companies can export and how quickly. Whether you believe it changes the world overnight or not, the existence of a known policy date changes behavior ahead of the date. Buyers front run. Industrial procurement gets more defensive. Inventory buffers get rebuilt, and traders smell the setup. That's why now isn't just a slogan, it's a timestamp. Fourth proof point, global arbitrage. Silver isn't one market, it's a web. London, New York, Asia, refineries, fabricators, ETFs, industrial consumers. In a calm world, arbitrage keeps regional prices aligned. If one place pays up, metal moves, and the gap closes. But in a stressed world, the gears jam, financing costs rise, logistics take time, and policy friction creates bottlenecks. When gaps persist, it is telling you something real. The margin allowance isn't T as mobile as the screen price implies. And that's where the tension builds, quietly, while the headline watchers argue about charts. Fifth proof point, institutional flow channels, the pressure valves. ETFs and ETPs can be a vacuum or a release. During momentum phases, inflows can tighten availability where it matters, because sourcing physical supply isn't instantaneous. During fear phases, redemptions can dump metal back into the system. Either way, flows create reflexivity. They don't just reflect demand. They can create feedback loops that amplify price moves. You don't need to know the exact tonnage to respect the mechanism. If flows accelerate when liquidity is thin, the market will overshoot. And then it will punish anyone who confuses overshoot with certainty. Because if this one level breaks, the math changes. Now, let's deal with the counterpoints head on, because ignoring them is how you lose trust and money. Yes, silver can be in bubble territory on certain relative metrics. One example that's been discussed, silver versus oil. Historically, it has often taken multiple ounces of silver to buy a barrel of oil. When that ratio compresses to extreme lows, meaning silver is historically expensive versus oil, it is a warning that speculative heat is high. It doesn't tell you sell now. It tells you respect volatility. It tells you that if the crowd is leaning too far, any shock, like a margin hike, can trigger a brutal shakeout. That's not pessimism, that's risk management. Another counterpoint, if there was a real shortage, price wouldn't crash. Wrong frame. In leveraged markets, price can crash precisely because there's stress. Stress creates volatility. Volatility triggers margin. Margin triggers forced liquidation. Forced liquidation crashes price even while tightness exists. That's why you can see tight physical narratives alongside violent paper pullbacks. The system is not a calm auction. It's a leverage machine with risk controls. And the controls kick hardest when you least want them to. That's why the next part matters more than the past spike. So here was the clean way to think about the fundamental constraint without pretending you can forecast the exact path. Silver supply is not a faucet. A large portion of silver production is byproduct, coming from mining of other metals. You can't just decide to mine more silver next week because price jumped. Even primary silver mines don't scale instantly. Refining capacity has lead times. Logistics have lead times. Recycling responds, but it's not infinite, and it doesn't flood the market overnight. Meanwhile, industrial demand is not a switch either. Solar, electronics, electrification supply chains have procurement schedules. Some demand can be deferred, some substituted, but not instantly and not painlessly. This is why silver can do something that shocks people. It can behave like a monetary asset and an industrial input at the same time. And that hybrid identity creates violent tug-of-war. The price tries to clear the market. The structure tries to contain the volatility. And when both forces collide, you get the kind of move we just saw. Now we bring it back to the claim in the title, they are panicking. Translate that into finance language. The system is reacting to tail risk. Not because someone is evil, not because there's a secret cabal, but because the incentives are obvious. Exchanges want orderly markets. Clearinghouses want solvent members. Brokers want clients who can pay. Funds want controlled drawdowns. When silver moves like a meme stock with industrial reality underneath it, the incentive is to cool it. Margin hikes are the most direct tool. Trading halts and limit dynamics are the emergency tools. Job owning and bubble narratives are the psychological tools. And the viewer, you, is the product if you don't understand that volatility will be used against you. That's the part that matters. Here's the viewer psychology shield, because this is where most people lose money even when they're right. Volatility is designed, by structure, not by conspiracy, to make you do the wrong thing at the wrong time. In a squeeze phase, it tempts you into oversized positions because the candles look like free money. Then, when the margin shock hits and price dumps, it tempts you to panic sell into the exact flush that deleverages the market. Then it rebounds fast, and you feel stupid, and you chase higher. That cycle is how accounts die. The antidote is boring, and that's why it works. Position sizing, time horizon clarity, and a simple rule to separate trend signal from noise. Trend signal is structure, higher highs and higher lows on meaningful timeframes, spreads that stay tight, the market holding key zones after shocks. Noise is the intraday chaos around margin headlines, thin liquidity spikes, and stop runs. Price can whip around violently even if the thesis is correct. So your job is not to predict every candle. Your job is to not get emotionally liquid. Now let's get specific, because you demanded what to watch next, not poetry. There are 3 zones that matter immediately. First, the low 70s zone, roughly $70 to $72. That's where the year-end liquidation printed. If silver can hold that area on retests, meaning it stops dumping through it and starts reclaiming it quickly, that S evidence the flush did its job and the market is absorbing supply. If it loses that area cleanly and stays below it, the tone changes. Not forever, but for the next leg. The next important area below is the high 60s. Think roughly $67 to $69 as the zone that would make the immediate reclaim narrative wobble. I'm not giving you fake precision, I'm giving you a practical map. Second, the mid-70s, roughly $75 to $76. That is where you all often see the battlefield after a shock, retests, failed rallies, then either a grind through or a rejection. If silver can push back above the mid-70s and hold it, it signals the market is willing to carry risk again, even after margin tightened. That's constructive. If it keeps rejecting there, it signals the market is still digesting leverage. That's not bearish long-term, but it means you should expect a chop and more traps. Third, the $80 to $83+ zone. That's the psychological gate and the recent peak region. If silver is going to revisit $80 in a meaningful way, it won't do it gently. It will do it by forcing one specific group to buy. Shorts and underhedged option dealers who must chase delta as price climbs, and funds who can't afford to miss the momentum. That's when the move becomes math again. But it will only work if the market structure stops screaming risk off. The tell is not your emotion. The tell is behavior. So what behavior are we looking for in the next week or two? First, watch volatility and margin headlines. Yes, But more importantly, watch how price reacts to them. If another margin hike hits and silver shrugs it off, meaning the dip is bought quickly and the market holds higher lows, that S bullish structure. If margin changes cause repeated cascading sell-offs that don't rebound, that's a sign leverage is still too dense and the flush isn't done. And that's where the real pressure starts. Second, watch the term structure. You don't need a PhD. You just need a simple question. Is the market paying a premium for now relative to later? Or is the curve relaxing? Tight front spreads and persistent urgency suggest physical tightness or near-term stress remains. A relaxing curve suggests the immediate panic is fading. Neither one guarantees direction, but it tells you whether the underlying squeeze fuel is present. Third, watch the physical symptoms. Premiums, availability, delivery delays, regional dislocations. Again, don't invent numbers, just watch for the trend. When physical tightness is real, you often see it in the friction. Longer lead times, higher premiums, unusual bid strength from industrial buyers who normally don't chase. That's not a TikTok conspiracy. That's procurement. Fourth, watch the institutional narrative war. When big commentators suddenly shift from silver is undervalued to this is a bubble at the exact moment margins rise, that's not proof of anything sinister. It's proof that narrative follows volatility. You do not trade narratives. You trade structure and risk. Now, here's the two scenario lens, because this is how you keep credibility when the market can do anything tomorrow. Scenario 1 is the controlled pullback and retest. In this scenario, silver chops around the low 70s to mid 70s, retests support, consolidates, and starts building a base that allows a later attempt at 80. This is the structure rebuild path. It feels boring compared to the spike, which is why most people miss it. The confirmation here is simple. Higher lows, fast recoveries from dips, and the ability to hold reclaimed levels like $75, $76 once broken. The invalidation here is also simple. A decisive break below the low 70s that doesn't snap back, especially if it drags into the high 60s and then fails to reclaim quickly. That doesn't kill the long-term bull case, but it pushes out the timeline and raises the odds of deeper mean reversion. Scenario 2 is the continuation squeeze with gap risk. In this scenario, silver doesn't give you clean entries. It grinds higher, then launches in thin liquidity, especially around key calendar moments. First trading days of January, option expiries, or policy implementation windows, because positioning is still lopsided and hedging flows become forced buying again. In that world, $80 is not a target, it's a magnet. And once it's reclaimed, the next move can be violent because everyone remembers what just happened and nobody wants to be short in front of a market that can print 83 plus again. The confirmation here is a reclaim of mid-70s with strength, a quick approach toward $80, and the ability to absorb selling without collapsing. The risk here is the one people ignore, gap risk. If it launches, it can also gap against you. If you're oversized, you won't survive the volatility even if you're right. And that's the part that matters. Now let's talk about the $80 number itself because it's doing psychological damage. $80 is not magic. It's a crowded strike zone, a media headline zone, and a round number that compresses decision-making into panic. When silver tagged the low 80s and then dropped, the market delivered a lesson. If you chase the candle with leverage, you are punished. That doesn't mean $80 can't happen again. It means the path to $80 won't be a straight line. And anyone selling you certainty is selling you into a future drawdown. So what does a rational what comes next checklist look like this week? Not in some vague eventually. Here it is in plain English. 1. Does silver hold the low 70s on retests, or does it slice through and stay heavy? 2. Does it reclaim and hold the mid 70s, or does it keep failing there like a ceiling? 3. Do the dips get bought faster over time or slower? 4. Does the curve show near-term urgency, or does it relax like stress is fading? 5. Do we get another risk control shock, margin, volatility spike, liquidity air pocket? And if we do, does silver absorb it or collapse under it? That's your map. That's your signal versus noise filter. Everything else is entertainment. And there is one more hidden layer you need to respect. The incentive to weaponize volatility against you doesn't require a villain. It's built into the ecosystem. Brokers love churn. Volatility creates churn. Social media loves extremes. Extremes create engagement. Your brain loves certainty. Certainty creates impulsive trades. The market doesn't have to conspire to take your money. It only has to remain a leverage machine, and your emotions will do the rest. So make a rule. Never make your biggest decision on the biggest candle. If you feel your heart rate rise, you're being trained to trade badly. Step back. Let the market show you structure, and that's where the real edge begins. Now, if you're in the metals crowd, skeptical, institution-wary, macro-aware, here's the clean, finance-literate interpretation of they re-panicking. That keeps you credible. The system is tightening risk because silver is acting like a stress test. A metal that can move from 83-ish to 72-ish in days is not just an asset, it's a volatility event. Risk managers respond, exchanges respond, and when they respond, it creates exactly the kind of shakeout that resets positioning, that can either end the move or set the stage for the next leg. The difference is what happens at the levels we just discussed. But that's not the part that matters. The part that matters is what you do with the information. If you treat this as a casino, you'll get casino outcomes. If you treat it as a structure problem, leverage, margin, hedging, delivery timing, you start making decisions that survive. You size positions so you can hold through noise. You define invalidation before the candle forms, not after it humiliates you. You respect that silver can be right on the big picture and still rip your face off on the path. And you stop confusing intensity with certainty. Here's the final synthesis, tight and actionable. The spike above 80 and the snapback toward the low 70s is not proof the bull case died. It is proof the trade got too leveraged into thin liquidity and the system pulled the lever that always works. Higher collateral demands and de-risking pressure. The hidden detail is that the battle isn't T only in the spot chart. It AS in the structure. Spreads, delivery mechanics, and hedging reflexivity. The why now is the calendar. Year-end liquidity plus risk controls plus a new year policy and supply chain uncertainty that changes behavior ahead of January. The near-term roadmap is the zones. Hold low 70s for stability, reclaim mid-70s for strength, and only then does $80 become a live magnet again. And the credibility anchor is two scenarios, controlled retest base build or continuation squeeze with gap risk, both possible and both tradable only if you respect volatility. And if you want one quiet, non-begging CTA that fits this audience, keep this as a process community, not a hype parade. In the comments, I want your checklist. Your own 3 tells you, I'll watch next week, and I want you to write your invalidation level before the market forces you to. That's how skeptics stay solvent. That's how you stop being exit liquidity for louder people. And that's where the real pressure starts, right where most viewers quit.